Hello and good morning, listeners. This is Almus Market Mornings with me, Shikhar Garg, and we bring to you the fresh updates of a marvel usually called the financial markets. Now, folks, central banks across have been quite aggressive with their policies on inflation, but few have now started to have concerns with this aggression. The recent one being the Australian Central Bank downshifting their pace of policy tightening. On the other hand, we saw some intervention kind of in action on the South Korean side, while the Indian rupee yesterday opened quite strongly, only to weaken by the closing. So, JK, kind of a mixed actions across the markets. What's your take? What's going on?
Hey, good morning. Actually, we are at a stage in the financial markets where things can take, a better turn or an ugly turn. That's actually equal chances because the key factor driving the markets, the inflation, is not showing any. It's not relating at all. At the same time, there are several side effects of the higher rates policy by the Fed on not only on the US economy going forward, but also on the global economy as well. And mainly the dollar strength is a talking point, which has been, having a huge impact on many weaker emerging market economies. What the US authorities might consider is a report, interesting report, which says that the North American companies lost 34.3 billion in April to June period, the highest loss on record because of the strength of the dollar. So the greenback strength has been most apparent in companies that derive a chunk of their revenues overseas and are exposed to weaker global consumer. And there have been other fallouts also from the unabated strength in the dollar, like a hit to international trade and threat to stability of indebted EM countries. And now the impact on the US companies depending on earnings abroad. So the US Treasury and government do not seem to be so far concerned about these and seem to have adopted a benign neglect attitude, but may not be too far for them to reconsider their stance because it can actually start affecting the market stability in their own country. One of the things I observed is the 30-year yield in the US actually crossing the 10-year yield for brief period yesterday. And this is nothing to do with the outlook on the economy in the long term, but it's more to do with the liquidity in the markets. And these liquidities are getting affected due to various factors, which are also global. And, one of the factors is also the strength of the dollar, because the strength of the dollar is inviting other countries to intervene in their markets and to find the dollars to sell. They have been selling US treasuries, creating more selling pressure. And as it is with the interest rates going up and terminal rates consistently inching up, there are more sellers in the market than buyers. Fed itself has been doing QT. So it's a very, very difficult situation for the US authorities, not to do something about at least the dollar, which can reduce some selling pressure on the bond market as well. In fact, there are reports which indicate that Treasury is seriously working on how to improve the liquidity on the bond market. Stock market, of course, yesterday has a rare two-day rally. This was helped by somewhat better than expected industrial production, as well as the one more corporate number like Goldman Sachs, reporting lower fall in the revenues. So actually, revenues have fallen, but the market had discounted a worse fall, and that actually kept the market on the highs. But there are also reports that Microsoft is looking to cut down on its workforce by about 1,000, and actually that confirms fears that the Fed's hiking on a steady basis has started to have its impact on the jobs market as well. In fact, there are some experts who are now looking for, 1990 type of a recession where there was a severe downturn in the jobs market that lasted for 20 months. So whether the markets are now seeing a bear market rally or a long-term bottom building depends on how far the Fed goes in its tightening cycle. And in fact, I think dollar is gaining a lot of importance in this cycle because of the effect it is having on the overall global stability of the markets. On the economic data, as I said, industrial production came slightly better than expected. So the manufacturing is not really so much impacted. It's only the housing market that is seeing severe downturn in the US. And yesterday's National Home Builders Association Index has actually fallen to 38 from 46 last month, and that's a sharp fall in the home sales. As it is affected by a big rise in the mortgage rates as well across the Atlantic. The Eurozone Zoo survey, or rather German Zoo survey, was better than expected, but the current conditions were in fact, worse than expected. It's a mixed picture for Europe, but there's one good news that is coming up for Europe is the gas prices, which have been steadily falling, and the storage in Europe has been very adequate as per the reports that we are seeing. Technicals on the natural gas prices look, somewhat weak, so they can fall further. So I think this is a near-term relief for Europe, but for the next year, the challenges will remain if they cannot ensure adequate supplies, even as they are planning to cut off their purchases from Russia. So it's a mixed economic picture in Europe and in US. The overall picture is looking good so far, but some signs of weakness are seen in the employment situation as well. UK markets have been steady, particularly the gilts and the pound are behaving well as of now, with both the government and the central bank focusing on stability of the markets. Interestingly, the QT program of Bank of England, which was ongoing before the crisis erupted, has been pushed further down to 1st November. This will be immediately after the medium-term fiscal plan, which the new finance minister is expected to present on October 31st. Overall, dollar is looking somewhat, steady at a lower level. I think waiting for a next push. Either way, looking at the technicals, I feel some more downside is possible on the dollar, but all hinges on the dollar yen, which is still, threatening to break into further new highs. Towards 150, with the verbal intervention from Japanese authorities of no avail so far. Interestingly, in the EM space, there is a mixed picture. Some of the while yuan remains weak, still just 0.3% away from the multi-year highs, there's some currencies like Korean won, Indonesian rupiah, and the Singapore dollar particularly have stabilized in the recent times. This is the effect of direct currency intervention as well as some policy measures which have been introduced. Possibly, I think markets are tiring a bit on buying the dollars. And I think it's not a general scenario, but it is a country specific. And if you look at Indian rupee as well, we did have a rupee taking inspiration from the dollar index fall on the previous day and traded almost as low as 82.03. But as we have seen in recent times, there was a vicious bounce from those levels as buyers emerged. It was not just a normal importance, but also rumored to be state-run banks which were reportedly buying for defense as well as government debt, and these may be just to ensure. I don't think these are meant to weaken the rupee, but definitely these are possibly to ensure that market remains in a stable range and without creating a big volatility on either side. But we still have to wait for the broader direction in the dollar index. I think a breakthrough 110 on the dollar index is possibly an indication or a big intervention in dollar yen. These are two factors along with flows that can help rupee to make further gains, but that's I think that is some more time to go to see that actually. Yeah, so we are in a slightly calmer markets right now, but this calmness can be disturbed going forward, depending on how the policymakers move. I think the lot of focus is on what the governments and the central banks do about the current big volatility in the bonds and the currencies. Thank you.
Okay, interesting, JK. And yes, folks, there are a lot of concerns, but as well as JK mentioned, we are in a quite a dicey state of the financial markets. The key factors that were pushing inflation higher have remained persistent, but similarly, the aggressions from the central bank has started to peering out. So there are a lot of mixed reviews that we are getting out of the sentiments from the market participants. On the other side, if we have to plot any sort of similarity or symmetry from the history of the financial markets, it depends on how the hiking cycle continues to decide whether, if it's going to be a long bottom or something which can be done within another 5-6 months. So that's that with the similarity. On the other hand, in the domestic markets, we were seeing as rumored that there is defense and debt buying, which led to further rise in USD INR after a lower opening. So a lot of things happening, and our objective will continue with another round of fresh updates coming up right for you tomorrow morning again. Till then, we take goodbye. Thank you so much for joining and listening.